Welcome to the Headley Highlight Show's Headley Headspaces. And this headspace is called Keep an Eye on the Japanese Bond Market. Japan is the largest holder of US debt. If they start dumping bonds, that contagion will spread. So before I jump into my headspace, which is called Keep an Eye on the Japanese Bond Market, they are the largest holders of US debt. And if they start dumping bonds, that's going to give everybody a headache. I'd like to say thank you to everyone who's listened, liked, or commented on my show, who's subscribed. They clicked the bell notification and selected all, and they will get all of my uploads as they come. And you might have donated. Thank you in advance if you have. And if you haven't, thank you in advance of when you are able to do so. I'm going to jump all over this because time is tight, and I've got something that I want to share with you. I like to listen to what's happening financially in the world. I can't say that I understand all of it, but some of the things that are out there just give you a little insight into the things you need to look at. Now, the other day, there was an election in Japan, okay? And Japan is the largest holder, I think it is, of US Treasury debt, bonds. Japan is in a very difficult position in relation to its debt and not being able to pay its debt that it owes. I think it not defaulted, but it didn't pay the debt that it owed to those people who loan it money. I think it was for one whole month. And therefore, the country, I think, has announced some sort of financial stimulus. Okay, that's what we're going to be talking about. But I'm probably not explaining it as well as the person who I'm going to share their content with you. They are explaining it. But the important thing about this is the issue about the number of countries who have significant proportions of large debt. The UK is included in that. America's included in that. Germany's included in that. France is included in that. Those markets are vulnerable. And those vulnerabilities put our financial futures at risk. Now, we don't usually hear the conversation in this way, but listen closely to this content creator, and then maybe we can chew over it when we've finished, if there's time, or if you don't want to. You might just want to, oh my gosh, think about it. But otherwise, I think this stuff is important. So keep your eyes on what's happening in the financial markets, people. Yeah, this situation with the Epstein, is shaking everything. It's shaking finance, it's shaking politics. And I'm not saying that this is majorly contributing to this situation, but you need to keep your eye on the things that are causing ructions. And that's one of the things that are causing ructions in the power structures. I've called them mycelium network. It's like a mycelium network of individuals, and we don't see it. We just see the end products of the things they want us to see. And maybe this is part of it. Let me know what you think. This is taken from a much longer piece of content. This person's cut it out. I've watched the whole piece. This piece is about 40 minutes long, but this is a snippet.
18 hours. That's how long it took for $7.3 trillion in global bond value to begin unraveling. Not a week, not a month, 18 hours. And what triggered it wasn't a war, wasn't a pandemic, wasn't a collapse. It was a single promise made by a Japanese politician on a Monday afternoon. One promise. $7.3 trillion gone. But here's what should terrify you. This isn't over. This is the beginning. What started in Tokyo 18 hours ago is now spreading to New York, to London, to Frankfurt, to every single portfolio, retirement account, and pension fund on this planet. Stage 4 contagion. That's the technical term for what's happening right now. It's the final stage of a debt crisis sequence. The stage where one country's problem becomes every country's problem. The stage where trillions in assets get repriced violently and permanently. $4 trillion. That's the conservative estimate of what's being liquidated. As you watch this, not might be liquidated, is being liquidated right now, today. And by the time this sequence completes, that number doubles. $6 to $8 trillion in global wealth transferred from people who don't understand what's happening to people who do. This isn't speculation. This is pattern recognition. This exact sequence has played out 17 times in modern financial history. And every single time it follows the same 4 stages. Every single time it accelerates faster than anyone predicts. Every single time the people who moved first preserved their wealth while everyone else watched theirs evaporate. So let me show you exactly what happened, why it's spreading, and most importantly, what you need to do before the next 72 hours make repositioning impossible. Here's what happened. January 20th, 2026. Japan's Prime Minister Sayaki stood before cameras and announced a snap election for February 8th. Standard political move, nothing unusual, except for what she promised voters. She promised to suspend Japan's 8% consumption tax on food. She promised increased government spending. More stimulus checks, more benefits, more programs, everything voters want to hear. One problem. Japan's national debt is 237% of GDP. Let me put that in perspective. The United States is at 125% of GDP, and economists call that a crisis. Greece collapsed at 180%. Japan is at 237%, the highest of any developed nation in human history. And Japan's prime minister just promised to cut taxes and increase spending with zero funding source. Which means one thing: more debt, more bonds, more borrowing. The bond market's response was immediate, violent, historic. January 21st, the 40-year Japanese government bond yield spiked 25 basis points in a single session. If you don't trade bonds, that number means nothing to you. So let me translate. In the Japanese bond market, yields normally move by fractions of a basis point per day. Sometimes it takes 3 months to see a 10 basis point move. They move 25 basis points in 6 hours. That's not volatility, that's a cardiac arrest. The 30-year yield jumped 30 basis points, hit 3.9%, highest on record. The 10-year yield hit 2.35%, highest since 1999. 26 years of yield suppression erased in one trading session. This was the most violent repricing of sovereign debt since the UK's Liz Truss moment in 2022. And if you remember what happened after Truss, you know what's coming next. But here's where it gets worse, much worse. Here's what nobody's saying out loud. This isn't a Japanese problem. Japan is the trigger. Japan is the first domino. But the chain reaction is global, mechanical, and already in motion. Japan holds over $1 trillion in U.S. Treasury securities. $1 trillion? They're the single largest foreign holder of American debt. More than China, more than the UK, more than anyone. For decades, Japanese investors bought U.S. bonds because Japanese yields were near zero. Why keep money in Japan earning nothing when you can earn 3% or 4% in America? So they bought, and bought, and bought. $1 trillion worth. But now, Japanese government bonds yield 2.35% on the 10-year, almost 4% on the long end. Suddenly, Japanese investors can earn the same yield at home. Same return, no currency risk, no exchange rate exposure. So they sell. They sell U.S. treasuries. They repatriate capital. They bring the money home. And when the largest foreign holder of U.S. debt becomes a seller instead of a buyer, U.S. yields spike. The day after Japan's bond market crashed, the U.S. 10-year treasury yield jumped 6 basis points. The 30-year moved even more. That's not coincidence. That's contagion. That's the mechanism activating in real time. And it cascades. Because every financial asset on Earth is priced relative to treasury yields. Stocks, real estate, corporate bonds, mortgages, everything. When treasury yields spike, everything else reprices. Lower, violently. The math says $4 trillion is the floor. By the time this sequence completes, we're looking at $6 to $8 trillion in global asset value destroyed or transferred. And that's not a prediction, that's arithmetic. Now let me show you why this is inevitable. Why this isn't just a bad week in bond markets. Why this is the beginning of a pattern that repeats with mechanical precision every time a major economy loses control of its debt. There's a sequence, 4 stages. Once you understand these stages, you'll see exactly where we are and exactly what comes next. Stage 1, the setup. This is where a government accumulates debt beyond sustainable levels, not just high debt, unsustainable debt, where interest payments start consuming meaningful portions of government revenue, where the debt to GDP ratio enters territory that historically precedes collapse. Japan spent 30 years in stage 1, 3 decades of deficit spending, stimulus packages that never stimulated anything, promises to retirees and voters that couldn't be funded through taxation, building and building until the debt was 237% of GDP. That's the setup, creating a situation where the only way to service existing debt is to issue more debt. Stage 2, the dependency. This is where the government becomes completely dependent on yields staying low. Because if yields rise significantly, interest costs explode exponentially. Japan's national debt is roughly $13 trillion. At 1% interest rates, that's $130 billion in annual interest. Manageable. At 4% interest rates, that's $520 billion. That's nearly a quarter of Japan's entire government budget. Just interest, not principal, not programs, not defense, interest. So governments in stage 2 do everything possible to suppress yields, central bank bond buying, yield curve control, financial repression, whatever it takes, and it works. For years, sometimes decades, yields stay artificially low, markets stay calm. Everyone believes it's sustainable. It never is. Stage 3, the break. This is where confidence shatters. Something triggers the market to question whether the debt is actually sustainable. A political event, a policy announcement, a central bank shift. The trigger changes, the psychology never does. Calm acceptance flips to questioning. Complacency flips to fear. And when confidence breaks in bond markets, the repricing is violent, fast, and irreversible. Selling begins. More selling triggers more selling. Rising yields cause more rising yields. A doom loop. Stage 4, the contagion. This is where it goes global. The crisis that started in one country's bond market spreads everywhere. Because modern financial markets are connected, integrated, correlated. When Japanese yields spike, US Treasuries get hit. When the US gets hit, Europe follows. When developed market bonds all reprice higher, everything reprices simultaneously. Currencies break, stocks collapse, credit spreads explode, wealth transfers massively from those holding long-duration assets to those holding short-duration safety and hard assets. This is the pattern, 4 stages. It's happened 17 times. It's happening again right now. Now let me show you this pattern in action. 3 times. 3 major economies. Same sequence, same outcome. United Kingdom, September 2022. Liz Truss became Prime Minister on September 6th. She promised tax cuts, deregulation, growth at any cost. Within 3 weeks, her Chancellor announced the mini-budget. September 23rd, £45 billion in unfunded tax cuts. Abolished the top income rate, cut corporate taxes, cut stamp duty, 0 spending cuts, 0 revenue source. Stage 1 had built for years. Brexit uncertainty. COVID spending. Debt over 100% of GDP. Stage 2 was the Bank of England's quantitative easing. Hundreds of billions in bond buying. Yields artificially suppressed, markets dependent on that support. Then, Truss triggered Stage 3. UK gilt yields exploded. Pension funds using leveraged liability-driven investing faced margin calls. Forced selling pushed yields higher. Higher yields caused more margin calls. More margin calls forced more selling. A doom loop in real time. By month's end, the Bank of England had no choice. Emergency intervention, unlimited purchases of long-dated bonds to stop the spiral. Truss's government collapsed within 44 days. Shortest tenure in British history. Stage 4 hit immediately. Sterling crashed. Mortgage rates spiked, housing froze. Pension values cratered. The wealth transfer happened in days, not months. Greece, 2010-2015. Stage 1 was years of deception after joining the euro. Cheap borrowing, hidden deficits. Stage 2 was complete dependency on low yields and constant refinancing. Then the truth emerged. Deficits were double what was reported. Stage 3 sent yields vertical. Greece couldn't borrow at any price. Bailouts came, then another crisis, then the largest sovereign default in modern history. Stage 4 consumed all of Europe. Portugal, Ireland, Spain, Italy. Credit spreads exploded, banks wobbled. The euro itself was questioned until the ECB stepped in with whatever it takes. Japan, 1990-2003. The original. 18 hours.
That wasn't exactly heartwarming news, but I think it's important news. It's important for us to not just look at things in isolation, but to see the interconnection between how these markets work and what the potential issues could be for us as ordinary people. Now that's actually a much longer video, and it kind of stopped there because obviously I don't think you want to listen to 40 minutes, and maybe you do, but the point for me was to just give you a little bit of an insight, to keep your eyes sometimes on what's being said to you. You know, this whole notion of growth that we keep having. We haven't had growth in this country since 2008, and even before then it was stagnated. So just think, when people are giving you certain bits of news and information, you know, the smart money might have already moved to save itself. So let's just keep our eyes out. I think it's time for an uplifting corner after this, don't you? You're gonna need an uplift. Anyway, look, I hope you like that little bit of financial insights. Keep your eyes not just on the headlines, but also on the financial indexes. And I will see you next week. Don't forget to make a donation, and it's a joy to be with you every Friday. Thank you for returning. And cut!